Hello and welcome to this week's edition of Mortgage Watch for April 4th. I'm Elon Auerbach with Unit Trust Mortgage. I'd like to begin by a little joke that'll set the tone for this week. And it's about Albert Einstein, and when he died, he went to heaven. And the story is that they were all full at the time and they couldn't give him his own room. He said, "That's fine, don't make a fuss over me, I'm an easygoing guy." They said, "We have to have you share a dormitory for your first, couple of weeks here." He goes, "That's fine, I don't mind." They brought out the people that he was going to meet, and they said, "Well, this first person has an IQ of 180. And he said, "Well, that's great, we'll be able to talk mathematics and stuff like that." And they brought out the next roommate, and they said, "Well, this person has an IQ of 150. He said, "Well, awesome, we'll be able to talk about physics and things like that." Well, this next roommate they brought out, they said, "Well, this person has an IQ of 100. He said, "Well, great, we'll talk about theater and the arts." And suddenly one other person came out and said, "I'm sorry, I didn't, wasn't ready to meet you before. I only have an IQ of 80. He goes, "That's no problem, I'm an easygoing guy. So tell me, where do you think mortgage rates are headed?" Oh, Bill knows it.
I didn't know it. I'm talking 20 years old. Which just shows you again and again.
It's making its rounds.
Yeah.
Well, in industry and market news for this week, several investment and depository banks have announced further losses in their subprime arena and all the related products that we have discussed that go with it. UBS, which is a giant Swiss bank, has announced a $19 billion loss, in addition to the 18 or 13 billion they had lost previously. Deutsche Bank, $3.9 billion, and Merrill Lynch, $3 billion. The chairman of UBS resigned, and previously the chairman of Merrill Lynch had also resigned. No word from Deutsche Bank. They're kind of like military commanders that fall on their sword back in the old days, and it was the proper thing to do. But really, almost like they're scapegoats. They have no idea what's going on in their companies. Most of these things are happening, in way off corners of these institutions. But kind of like racehorses that get put out to pasture after they earn a lot of money, these guys get giant severance packages. So they can't be in too much trouble because they're walking away with tens of millions of dollars. I don't know what's really going to change at those institutions, except a lot more regulation, which is going to come, which is a good thing, we think. National City Bank, which was a giant lender and owned several subprime lenders in its time, is staggering around still looking for a buyer. They have been hit with a lot of losses. They also had a warehouse bank that dealt with a lot of subprime and poor credit loans. All right. Someone didn't like that. Bayview Capital, which is a giant mortgage and banking and capital firm, announced layoffs at its subsidiaries Interbay and Silver Hill, which are the two nationwide lenders that it has out there in the marketplace. These layoffs and slowdowns probably are because Bayview cannot securitize.
And may unmute themselves by pressing *6.
Thank you. These are people who are tuned into our conference today. It's a conference call, as some of you may know. Bayview probably can't securitize its loans, and since it can't securitize its loans, it can't replenish the money that it uses to lend. This isn't a good thing for the commercial arena, but it is what's going on. There are continuing problems in the auction rate market. We have talked about it in previous weeks. Auction rate funds are temporary loans. They typically reset every week. That everyone is being told is like a money market account. It's just like a cash account. There's no problem with it. Well, like with many other things, people are realizing there are serious problems with it. That market, as we've discussed earlier, is completely frozen, so people can't get their money out. It's mainly been for private, wealthy investors, but giant banks hold a lot of these notes also. And the problem is that because nobody wants to buy any of them, nobody knows what they're worth, and nobody can get out of them. So you have individuals who invested $2 or $3 million in these things, and we're told, "Don't worry, you can get out any time. It's like a money market account." Well, they can't because there's no buyer for these things. On the other side of it, giant institutions like Louisiana Superdome and the New Jersey Giant Stadium and lots of stadiums all across the country are financed with auction rate securities. So even though they went out expecting to pay 4.5% and 5%, which they were, they're now paying upwards of 20%. So their debt service has gone up fourfold. I'm wondering who's making the money on that. Somebody is, but we don't quite know whom. This is a $330 billion market, and so it's a giant market that up until very recently has gone completely under the radar screen as far as regulation or knowing how it really works. And along with that, there was a super Fed agency announcement by Secretary Paulson earlier this week, For those of you who didn't hear it, they're going to pull together all the different federal regulatory agencies that oversee banks and the markets and so on into one giant agency. And that's really important because what's been going on so far is a hodgepodge of laws that really date back to the 1930s and the last Depression. So it kind of very, very hard to regulate the modern economy and world markets with that. It's kind of like playing a football game with one referee who's trying to keep up with all the action. It's just way too much going on, way too fast. And so a super Fed agency will hopefully help everyone and our economy, and that is good news. Ben Bernanke, the Federal Reserve Chairman, announced what's probably not a secret to anyone but himself, and that is, he said, a recession may be near. Everyone around the world basically already knew that, and now the question is being asked, what else can you do to minimize that recession? It's kind of like the steroid scandal in baseball. Everybody knew that the players, some of the players setting records were taking steroids, but still baseball was saying, well, we don't really know there's a problem, we don't really know what's going on. So now that it's out in the open, hopefully the Feds can take some stronger action. So now I'm going to share some good news with you, and that is that there is a $15 billion financial aid package that's winding through the Senate. This has some builder incentives. It also has buyers of foreclosure property incentives. How that is an incentive, I don't really know, but it's going to keep things moving and keep the marketplace going. That's all being done to stimulate the housing market. There's a second proposal going through the Senate that would allow the FHA to insure an additional $200 billion in loans, which again, the whole idea of all this is to stabilize the markets, get everybody to lower their level of anxiety and start investing again. These are, again, investing large companies buying paper to stabilize the markets and kind of lower where we are with rates. Unfortunately, with all this, I'm not sure where stated income borrowers are going to be. And there are a lot of really, really strong stated income borrowers. I'm not sure what they're going to do to refi or what's going to be available. But finally, we have some real relief going on. It's almost as if for the last 6 months, the Fed said, well, take 2 aspirin and then, let's see if it gets any worse. Well, it's gotten a lot worse. They finally realized they got to pull out the heavy medication at this point, and those are coming. And again, we've been asking for that and looking for that. So that's really, really good news. Well, now I'm going to give you the Albert Einstein update of mortgage rates. And mortgage rates have continued to be volatile, as has the stock market, up and down in the recent week. We still have a very large spread between mortgage rates and treasury rates. And everything the Fed is doing is designed to kind of lower that spread so that mortgage rates are more in line with where they should be, which is probably about 1% less than where they are right now. So we're looking for that to happen, and we're advising clients and anyone out there thinking of buying to, again, get started with the process. Do not wait until the process has gone by you. It's time to get started. There's no huge rush to lock in rates, although some days we have very, very strong rates. The problem is those rates are disappearing in a couple of hours, but we can potentially time that. But it is a good time to go out there. If you're thinking of buying, again, there are some hot deals out there. There are a lot of people eyeing that market, and as one of them said, it's impossible to time the bottom of the market. No one really knows where that is. But if you're out there looking now, you know that you're buying at a very, very opportune time. And I think you'll be rewarded if you start making your move right now. Just to put things in perspective before we close, there's been about $130 billion in announced losses by various institutions, Wall Street firms, and banks. There's approximately $15 to $30 billion in federal tax aid that's being proposed right now to help builders, buyers, and also existing homeowners to refinance. The newest bill in front of the Senate is a $200 billion bill just to help provide insurance. It will not actually be an outlay of money, but it will cover about $200 billion of mortgages. And there's a new book that came out this week by an economy professor at Yale that showed that the war in Iraq is costing the United States $144 billion a year. And so far, it's cost the United States $1 trillion. Just want to put into perspective the housing problem and the other things that our government is involved in. I try not to get political in these things, but it's a book that everyone is talking about, economists and everyone else, and it is part of what's going on with our economy, so I wanted to share that with you. Well, that's the basic news and update for this week in Mortgage Watch. We invite you to join us next week. We'll have an update for you. In the meantime, I wish you a great week and a successful week. Thank you very much. Bye.